right, good morning, everybody. It is Saturday, September 18th, about 9:30 in the a.m., and I figured I'd do a follow-up video here. I sent an email out maybe Thursday this week, I can't remember exactly, that the S&P 500, the NASDAQ, and to an extent the NYSE and the Russell have reached the resistances that we had laid out back in the June video, and the NASDAQ and the S&P 500, particularly the S&P 500, came back. It tried to exceed the box, returned, and then when it tries to test it again, is a very typical breakdown location. So there was some clues there that we were likely to see further breakdown, and if we saw a lower low than we saw earlier in the week, that we could be in for some trouble, and the market took that direction. So there may be some better indication now that the market could be ready for a larger degree correction. So there's really nothing new in this update. It's pretty much the same spiel that I've been purveying for a long time, but just a quick rehash. If we look at the S&P 500 by itself, and we look at the move off of the March 2020 low, I prefer this move as a three-wave structure. I do not like it as an impulse. I reject the targets that the impulse shoots for, and we can touch on those in a second here when we go over the bullish alternative. But same deal, three waves up into the April 2020 high for wave one, a three-wave correction for wave two, a running flat, and I'm quite happy with the shallow corrections that I've drawn. Because they're throwing everything they have at this market, and I'm okay with the shallow corrections given those circumstances. I have a three-wave rally, right, for our wave three, and I'm unsure whether I should finish it here or here. This is a very small wave four. This would be a larger wave four, and I'd be more satisfied with that. But either way, it counts fine in either direction. And then a three-wave rally for our wave five, right? So this is probably the more appropriate way of counting it, but I've been toying with either. And then this becomes an ABC for A, for a larger ABC for the fifth wave of our third wave of five. We'll go back and we'll zoom out and we'll talk about that. Right, so I can make the case for this to be a completed structure off of the March 2020 low under this interpretation, and this is my base case. So if we zoom out and we go to a daily chart, let's go to a weekly chart. I'll tell you what, 2-day chart. Looking at the 2-day chart, my expectation off of the 2008 low is that we are within an impulse, and that this portion of the wave here, it could be counted as complete if you were to move your 3-4 back to here. That would allow for this to be the next larger wave, right? So this would then become the 4, and then this would become the 5. And to be honest, that was my base case back in March of 2020. But the strength of this rally makes it look a whole lot more like the fifth of a third wave, right? So I think this is the more appropriate way of counting it, based on the evidence that we've been presented more recently. I think this is more appropriate. Let me move all these back to where I had them so I don't have this screwed up. There. So if that's the case, if this is the fifth of a third, we're now running into that resistance from the fib array that I've laid out here off of the 2009 low. And if we are completing the fifth of a third, then we should see a larger correction back. We had a fairly large correction in this area, so I'm not expecting one that is exceedingly large in this area, but it would be allowable to pull back into the 2100 region again. But based on the size of this correction, I would not be expecting that. And I'd be happy with any correction that got us back into the 3300s. That would be plenty deep, I think, for the context. And again, if we just talk about the kind of correction that I'd be expecting, I think we've got all kinds of people in the market that are just, we got tons that are betting for higher, and we got an awful lot that are betting for lower too. So when the market, my perception is that when the market is in a condition like that, the market makers lose too much money if the puts fulfill. They lose too much money if the calls fulfill. So what they have to do is just grind the market sideways or get everybody out somehow. And they usually do that by just screwing around with price for a prolonged period of time until the options, basically go worthless, or until enough people say this is never going to happen and they willfully drop their positions before they go negative. So, a move I would expect would be something that is just, horrifyingly choppy and difficult to trade, for quite some period of time, and then maybe there's a finishing flourish or something like that. At the point where everybody is ready to buy this thing again, where they say, oh, that's long enough as far as a correction is concerned, and we're ready to buy this thing. So I think you may get a finishing dump when that happens, and that would fulfill our wave 4 before we take off in our rally. Before we take off in our rally for the 7,000 region, which is my target for the entire move off of the low that was initiated at the outset of the Great Depression, or actually prior to the Great Depression. So if we zoom out and look at that, that would be a 2-month chart. I'm counting the Great Depression as a leading diagonal for 1, 2, and then I think we are headed into this high here when this move to 7,000 terminates, and then the market has to take a long period of time to digest the gains that we've seen, reset itself for the next major leg higher up into the 77, 80,000 area on the S&P 500. But that's probably not going to be within my lifetime. I don't think I see wave 4. A natural endpoint would probably be somewhere in the 2070s. Is it even the 2070s, or is it the 2170s? No, it's the 2070s until this wave 4 would finish. Just given proportions. I don't have any really strong evidence of that timing yet, and that's not something that I really work on. So that's the medium term, the short term, the medium term, and the long term view of the S&P 500 based on what we're seeing now. So if we go back and we look at the 1 hour view, and we talk about how we get, how this develops, we're in the midst of a decline now, and that decline, I was using this pitchfork to as a timing measure for my diagonal that I was forecasting for the ending move here. And generally, when price is able to break across this midline of the fork, she's basically cooked. Now, there's some question as to whether or not I have this fork positioned properly. There always is some question as to whether or not I have that right. So I'm not 100% sure that it's ready to go. Maybe this is the appropriate positioning. And maybe it's going to be able to catch a bounce here and try again before breaking down. But I had it positioned here for a long time. I don't really like to move my stuff around a whole lot after I position it. So I've had it here for some time, and I'm gonna go with what I had, and we'll see how this develops. But this is the base case, and I believe we have crossed over that median line, and that to me is signifying that this thing is ready now to begin that decline. All of my very short-term charting is done on the futures chart, and I still have a couple of options here available to me for how this can complete, but this is the one that I am now tracking, I believe is now tracking closest with what's happening, and I'm drawing it as an impulse to the downside that could finish around 42.09, but it has every right to be an A, B, C that finishes, it can terminate at one of these threes, here, here, or here. This one here or this one here would be my preferred targets. If we go back and we look at resistances, we have some resistance here, and we have some resistance here. So either one, this is the first one. So it's very possible that we come back into this area and find some support. Let's make that red before we bounce again and then continue lower. And then that one could be even, an even more voracious sell-off. Once that bounce completes back up into this area, this could be an even more voracious sell-off than anything we might see here. And that is, probably going to get us our first wave, down into this area before another bounce and further down again, if this is the correct pattern, if I'm projecting the correct pattern. Again, as I've mentioned, I'm not chasing this with the aggression that I chased the drop in 2020, just because I'm not as convinced that we are at a top as I was back in the 2020 timeframe. There's still room for this to do a few other things, but I'm going with the weight of evidence and starting to chase this thing to the downside now. Some of the things that really are leading me to that position, we've gone over that. The NYA, which is the NYSE. If I go to a 2-week chart of that, I believe this move is a diagonal off of the 2020 low. I believe this is an ABC for 1, 2, an ABC for 3, and then we've got overlap here, right? This comes back and overlaps the top of this, right? So I think we've got a diagonal in the works here, and if that's the case, we should have been topping out right at this red box, and I may or may not have that positioned exactly right. It's difficult to tell. But on the 4-hour chart, I think I can count a nice ABC structure to the upside. An A, a B, and I moved that, and a C up into this resistance. And we're really just kind of grinding in this area. I can't eliminate, the possibility of one higher high that gets up into this area, or a breakdown. It's a difficult, it's difficult to say what this thing is doing in this area. It's been a sideways grind now for several months, and that opens up the possibility for several outcomes when you have, price just chop around in an area for as long as it has. So, room for upside, limited, if this is the correct interpretation. Can it go up? Yes, but I believe the room for upside is very limited. So, and the Russell, I believe, should count that way as well. I think the Russell and the NYA are very similar to each other, and the S&P 500 and the NASDAQ are very similar to each other. So, I think the Russell and the NYA are both diagonals and are both at their resistances. as are the NASDAQ and the S&P 500. If we look at some other things, the dollar, I kind of think the dollar's in an ABC to the upside. So I think we finished the A and the A wave. I think we finished the B wave correction, and I think we need an impulsive structure to the upside now to finish an upside correction in the dollar, and that's going to fly completely in the face of what anybody else thinks, and that's going to be hard for people to understand if that actually takes place. But that is my base case scenario on the dollar. If we talk about, we had done some updates on Bitcoin previously. Bitcoin, our base case on Bitcoin was that it was actually going to be bottoming in this area here previously. I think our previous update had either this low or this low as the bottom. I'm going to say I think it was this one. And then we expected a diagonal pattern to the upside to finish somewhere in the 126,000 area. After that update, Bitcoin continued to attack to the downside a little bit more than we would have liked to see. And I think this now counts as a 5-wave pattern to the downside as a diagonal. If that's the correct interpretation, Bitcoin should need one more low, or it would need to, turn into a crappier, less predictable pattern like a triangle. Because that's really the only time we see really disorganized ABCs that really walk the line, are if things turn into triangles, and it would forecast price action like that. I'm not really fond of that alternative. I think we're actually going to see, this could be a 3-wave bounce here, and we're going to see one more low, maybe just a slightly lower low as a C wave before we can see this push higher up into the 126,000 region. Before we were talking about a diagonal move to the upside. It's still possible, right? This move is not clear enough to be concrete in any form of analysis, so it's still possible that this works its way out as a diagonal to the upside. But I certainly am I'm much more lukewarm on that potential than I was previously. I think this is becoming the preferred alternative now in Bitcoin, is to see something with a nominally lower low before we resume that attempt at the 126,000s. So that's kind of my thoughts there on Bitcoin. If we go and we look at, what else were we looking at? We had some ratio analysis that we were checking out. All of those are still at ridiculous measures. My VIX analysis, the way I interpret the VIX, I believe this is the pattern I want to see in the VIX. And we are at that peak. Remember, this chart is inverted, simply because it's easier for me to analyze when inverted, which means if we drop, the VIX is actually going up, which means volatility is increasing. And if volatility is increasing, that's generally an indication that people are scared of what's happening, and that generally means that the market is not performing as expected. Volatility goes down when the market is acting in a predictable manner and investors are not freaking the hell out. So if volatility goes up, remember this chart's inverted, if volatility goes up, we should expect to see a correction in the S&P 500. And I think that bodes nicely with that pullback that we're talking about. And then this can be a nice impulsive move to the upside to finish off in the 7,000 region when we see this upside pattern here. That's the VIX. The other charts are still in just a retarded spot. I mean, the 21-day moving average of the put-call ratio is just still in retarded territory up here. This is crazy stuff, and it's been here ever since September of 2020. It's been there so long that I almost can't use it as a form of analysis anymore. other than to say that it's just ridiculous. The ratio of the TLT to the SPX is now also at a spot where I'm expecting inflection, right? I think this chart is a diagonal, and I think that is at a spot where we're ready to see that pull back. And I used to have the gold oil ratio here, but I'm messing around with some new indicators. And this one is based on the advanced decline. And I think that's, based on what I've seen so far, I haven't been tracking this that long, that's pretty damn high. And when we get up in that area, the only other times that we've been that high have been in this zone, which foretold this decline. It's really the only other time that we've been outside of that upper band by that much, and we happen to be there now. But really, almost all times that we've been in this upper channel, price has struggled to advance much further without some kind of decline occurring. Unless you're in the very genesis of a wave in this portion, and I wouldn't say that we're in the genesis of a wave, I would say that we're completing. I'm still working on this. This is replacing my gold oil ratio, which is completely fucked after the oil went negative. The chart is just so messed up I can't even really use it. So this is the next thing I'm working on as a replacement for that. We have the secret indicator, which is based a lot on new highs and new lows in the NYSE. And anytime that we start to see the orange line fall below the blue line, and then once the orange line falls below the red line, it actually triggers a sell signal, which are the red lines on these charts here. And this system has been pretty good. The back test on this is pretty good. And I'm expecting a sell in this indicator potentially as soon as next week. Price is already made. The signal line has already dipped below once, and if we see continued downside here, I think we'll see the signal line go below again, and that will probably now also drag the orange line with it now below the red, and for the first time in quite a long time will elicit a sell signal finally in this tactic, in this trading tactic. So I think we're going to finally exit the long-term portfolio trades that are generated by this system. I think we're finally there. So that's pretty much it. We're still, still got a lot of things that are pointing to, headwinds in this area. So as a follow-up to the last video, saying all the same things, regurgitating all the same information. Charts haven't changed. We're just now there, finally, I think. So that's it. As I mentioned in the email on Thursday or Friday, I'm certainly protecting myself in this area. I'm not carrying much, in the way of stocks to the long side, and I am eagerly looking for short opportunities when they present themselves now. I believe the direction of the market is ready to shift, and short trades will be the bias here for the next little bit. Again, I expect it to be a disgusting, almost untradeable pattern for many people. That really burns a lot of option premium and gets people just sick and disgusted with the market after a while. It's been very forgiving for most people and sucked an awful lot of them in. I think it's going to really hurt those people that think they're going to be able to continue to get this kind of action out of the market, and I think that's by design. They're going to need to burn out all the option players that they can so that premium cannot be collected. And then once they finally get them bearish enough, they're going to let this thing take off, finally, for that 7,000 region. And that should be the last hurrah for for positive economic stuff here in the United States for quite some time, in my opinion, somewhere out in the 2030s. That's it for me on this update. I hope you guys have a good weekend, and I will catch you shortly. See you guys.